In conjunction with NAREIT's REIT Week 2020, which is being held virtually this year, I'm joined today by Spenser Allaway, the net lease, gaming, and self-storage analyst with Green Street Advisors. So Spenser, there are many overlapping characteristics between the gaming sector and the traditional net lease space. Can you just walk us through some of the key similarities and differences of these two REIT sectors?
The primary commonality between the two sectors is the structure of the lease. So in both cases, the REITs are leasing real estate to tenants under long-term triple net leases, which can range anywhere from 10 to 30 years and are typically subject to an annual rent escalator that varies between about 1% and 2%. In addition, under these triple net leases in both sectors, the tenants are responsible for paying property taxes, insurance, as well as maintenance, CapEx, and other repairs. In terms of the differences, the primary differentiator is really the tenant base. So in the traditional net lease sector, the REIT portfolios are highly diversified, not just across property types with exposure to retail, office, and industrial, for example, but they also have hundreds of tenants, with no one tenant accounting for more than about 5% of annual rent. In gaming, however, the three REITs that dominate this space were all either IPO'd or spun from a major gaming operator. And as such, they derive roughly 90% of their NOI from just one tenant. So clearly a stark difference here with the gaming REITs having significant tenant concentration relative to the traditional net lease space.
You mentioned the high level of tenant concentration in the gaming sector. Can you elaborate on how important it is to monitor the operator's health and what metrics the investment community should pay attention to?
Well, monitoring the operator's health is extremely important, even with a healthy economic backdrop. The obvious reason that the REIT's NOI is so highly dependent on just one tenant. However, this topic is particularly important in today's environment, where due to the COVID pandemic, casinos have been closed across the US for over 2 months and are only just beginning to reopen in some states. So when Green Street currently assesses tenants' rent-paying ability, we're primarily focused on the operator's liquidity in a zero revenue environment. So we're looking at cash on hand, monthly cash burn rates, as there's still costs associated to upkeeping and running these assets, access to the debt markets, and then with all that being considered, trying to gauge how long these tenants could pay rent with no revenue coming in the door before they would ultimately be in default of their leases. And then lastly, it's also important to pay attention to the difference in operational costs between a regional and Vegas asset. So not surprisingly, Vegas assets typically have much higher operational costs due to their lodging, entertainment, dining components that the regional assets typically do not have. And this can really weigh on a tenant's liquidity, particularly if demand, or i.e. revenue, is not strong enough to offset the costs associated to keeping the asset open.
And finally, you just mentioned the difference between regional and Las Vegas-based casinos. As we think about a post-COVID-19 world, how do you see an eventual recovery playing out for regional casinos versus those that are located on the Strip?
Historically, regional gaming revenue has proven to be more economically resilient than that of Vegas. And we do think this will continue to be the case for a few reasons. So first, regional demand is primarily driven by local patrons that visit several times a week and live within driving distance. So these consumers are able to visit their local casino without the need to travel by air or stay at hotels. And then secondly, the impact from COVID has not been quite as severe in less urban metros. So this could alleviate some consumer concerns of returning back to assets like casinos where people have to aggregate in masses. Vegas, on the other hand, as we all know, is highly dependent on tourism, with roughly 50% of its visitors arriving by air. It also has a very competitive supply landscape that regional assets don't face. Now, in a normal economic environment, casino demand can overcome the heavy supply base in the Vegas market. However, because of COVID, even after all the casinos reopen, it does seem reasonable that demand in Vegas could remain tepid for some time until people are simply feeling more comfortable to travel again. And then, of course, we get into the much larger debate related to what business travel looks like in a post-COVID world. Because to the extent that business or convention travel, which is an important demand driver for Vegas, to the extent that that is hampered due to the changes in how people choose to conduct business, this could really negatively impact the Vegas recovery. So certainly a lot of unknowns regarding what a recovery looks like and what consumer behavioral patterns could be post-COVID, but we do think that regional demand will come back faster simply due to the fact that it is not dependent on air or business travel.
Spenser, thank you so much for joining us.
Thank you so much for having me.
For more related to REIT Week 2020, be sure to visit REIT.com.